In Chapter 12, we'll be talking about the statement of cash flow. In financial accounting, there are four basic financial statements: the income statement, the balance sheet, statement of retained earnings, also known as the statement of stockholders' equity, and the cash flow statement. In Chapter 12, we'll be talking about why the cash flow statement is important, and then we'll be talking about the fact that you can produce the cash flow statement using either the indirect method or the direct method. So the cash flow statement is important because the cash flow statement discusses all the reasons why cash is coming into a business and all the reasons why cash is going out. So if you have a statement that just discusses how much cash is coming in and how much cash is going out, then you can identify a number of different things. So here we have four things listed. The cash flow statement helps you to identify the entity's ability to generate future cash flows, their ability to pay dividends and meet obligations, because that needs cash in order to do that, reasons for difference between net income and cash provided by operating activities. In other words, when you have net income does not always mean that that's the amount of cash that you have, because net income is on the accrual basis of accounting. The cash flow statement also provides information on investing and financing transactions for the period. So the cash flow statement is a list of all the reasons why cash is coming in and all the reasons why cash is going out. And the cash flow statement is organized into three different sections. You have the operating activity section, investing, and then the financing activity section. So O, I, and F: operating, investing, and financing. The cash flow statement is always going to appear in that order. Now, in the operating activities section, in the book, it says that the operating activities includes income statement items, but we can also say that the operating activities section includes revenues, expenses, current assets, and current liabilities. So the operating activities section: revenues, expenses, current assets, current liabilities. In the investing activities section, it only includes long-term assets, or anything with the word investment in it. In the financing activities section, it includes long-term liabilities and stockholders' equity. So in the operating activities, again, it includes revenues, expenses, current assets, and current liabilities. You would include all of your cash inflows and your cash outflows. So here's a couple of commonly included items that would be in the operating activities section. In the investing activities section, it only includes two things: anything with the word invest in it and long-term assets. So anytime you sell property, plant, and equipment or purchase property, plant, and equipment, that would be in the investing activities section. If you sell investments or buy investments, that would be in the investing activities section. And if you have a loan receivable, like a long-term loan receivable, or if you make a loan to another entity, then that would be in the investing activities section as well. Financing includes long-term liabilities and stockholders' equity. So if you sell stock, or if you borrow money, long-term debt, if you pay dividends, or if you redeem your long-term debt, that's going to be in the financing activities section. Now, some things have nothing to do with cash at all. These are typically just exchange items. So if you, for example, trade land and you get stock, then there's no cash involved in that transaction. So that would be a significant non-cash activity. If you have something that's a significant non-cash activity, it's a large amount, and it has nothing to do with cash, it would still go in the cash flow statement, but only at the very bottom. So here you can see what a cash flow statement is going to look like. So in this cash flow statement, we have operating activities. So this would include revenues, expenses, current assets, and current liabilities. Investing, that would be long-term assets and investments. And financing, which is long-term liabilities and stockholders' equity. Now, if you prepare a cash flow statement, you can either do the indirect method or the direct method. Let's go back here. So when you do the operating activity section, there's two ways to do it, the indirect method and the direct method. Everything else is done the same way. Now, the only difference is that if you do the indirect method, you're going to have net income. If you do the direct method, there is no net income. What you need to know is the indirect method. So how do we prepare an indirect method cash flow statement? Well, you're going to need two balance sheets. You'll need last year's balance sheet and this year's balance sheet. You'll need an income statement and then additional information. So here's an example. Here's an income statement. So you can see here that the net income was $145,000. Here are what we call comparative balance sheets. So we have last year's balance sheet. So last year was 2021, and then the current year, which in this case is 2022. Notice that they have a change in account balance increase decrease column. That's very important. So you can see, for example, account receivable last year was $30,000. This year it's $20,000, so it went down $10,000. Now, this is the rest of the comparative balance sheet. This is the liabilities and stockholders' equity section. Here's the additional information. So additional information typically just gives you more detail that you wouldn't be able to see on an income statement or balance sheet. For example, let's look at number 4. For number 4, it says that you have a building which cost $120,000 that you purchased for cash, and equipment which cost $25,000 and that was purchased for cash. Now for the operating activity section, we're going to focus on doing the indirect method. Remember, the indirect method has net income. So if you put net income in the operating activity section, you have to make some adjustments. The reason why is because net income is on the accrual basis. So when you get net income, you have to subtract depreciation expense to get the net income. So when we do the operating activity section under the indirect method, we start with net income, and then you always have to add back depreciation, amortization, depletion. So just depreciation, know that. The reason is because to get net income, you subtracted depreciation. So take a look at this income statement here. So here, notice that depreciation is $9,000. We subtracted $9,000, that was an expense, and then that gives us our net income, which is $145,000. So if you want to do cash flow statement, depreciation has nothing to do with cash. When something depreciates, you're not physically giving anybody anything. So if we do the operating activity section indirect method, we take net income, we add back depreciation, and then the next thing we do is we deduct any gains and add any losses. The reason is because if you have a gain or a loss, it's always because of something long term. So for example, if you have a gain on sale of land, then the entire amount, including the gain, should be in the investing activity section, because the investing activity section deals with long-term assets. So we don't want to include the gain and the loss in two places. So to cancel out the gain and cancel out the loss, you deduct the gain and you add the loss. Finally, in the third step, we're going to look at all of our current assets and current liabilities. That's going to be in the operating activities section. So here's part of the operating activity section. You can see we have net income, $145,000, and then you always add back depreciation expense. Remember, you deduct any gain, you add any loss. So here, if we have a loss, you can see we're taking the loss and we're adding it back. Okay, so we have 145,000 plus 9,000 plus 3,000. And here is a chart that summarizes what you would add or subtract. You can see here depreciation expense is added, loss is added, gain is deducted. Now notice what we do next is we have 145,000, we add depreciation, we add the loss, and then you look at all of your current assets and current liabilities, and you see that we have account receivable decreasing by 10,000. Okay, so that was from here. Account receivable, you can see account receivable is decreasing by $10,000. Okay, so if account receivable is going down, if fewer people owe you money, then that's more money in your pocket that you have. So you're going to add $10,000. If inventory goes up, then you must have purchased inventory, so you subtract, because having more inventory means you probably have less cash. The easiest way to remember this is to look at this chart. If a current asset goes up, you deduct. If a current asset goes down, you add. If a current liability goes up, you add. If a current liability goes down, you can deduct. So this is a very handy chart to have, and you can use this when you make the cash flow statement. Okay, so at the very end, we see that net cash provided by operating activities is $172,000. And that concludes the presentation here. I recommend that you take a look at the cash flow statement that is in the text, and then when you go over the problems, if you have any questions, please let me know.